Right now, the Social Security Administration is quietly rolling out rule changes for 2026. These changes will not make headlines on the evening news. Yet they could shift your monthly benefit by hundreds of dollars over the coming years. If you are collecting Social Security or plan to soon, this video is exactly for you. Most seniors I talk to believe the only number that matters is the annual COLA adjustment. That is a dangerous assumption, and I have seen it cost good people real money. There are at least 5 lesser-known changes taking effect in 2026 that almost nobody is discussing. I am going to walk you through every single one of them today. In my 30 years as a financial advisor, I learned one painful truth over and over. The rules that hurt people most are the ones they never knew existed. By the end of this video, you will know things your own Social Security office may not volunteer. So grab your coffee, settle in, and let us protect what you have earned. Before we dive into the hidden changes, let us set the stage with some hard numbers. According to SSA.gov, the average retired worker benefit in early 2025 was roughly $1,976 per month. That figure is projected to rise modestly in 2026, but the increase is smaller than many expected. The Social Security trustees project the trust fund reserves face depletion pressure by the early 2030s. The 2026 cost of living adjustment is currently estimated to land between 2.2 and 2.5%. That sounds helpful until you realize Medicare Part B premiums often eat into that raise. Think of it like getting a small pay bump at work, but your parking fee goes up the same week. The net effect on your actual spending money can be disappointing or even negative. Here is an analogy I used with clients for years that makes this crystal clear. Imagine your Social Security check is a glass of water you drink from every month. COLA is supposed to refill the glass to keep up with rising prices. But if Medicare premiums, taxes, and rule changes each take a sip first, you end up thirstier than before. The Social Security Administration updates several key thresholds every year based on national wage data. These include the earnings test limit, the taxable maximum, and the substantial gainful activity amount. Each threshold shift creates a ripple that touches different groups of seniors in different ways. Most people only hear about COLA and miss these quieter but equally important adjustments. One more piece of context before we get to the real substance of this video. The SSA processed over 70 million payments each month in 2025, according to their published data. Even a tiny rule change applied to that many people creates enormous collective impact. You deserve to understand exactly how these shifts touch your personal bottom line. Now let us get into the first major hidden change that could affect your 2026 benefit. The Social Security earnings test limit is increasing for 2026 to an estimated $23,400 for those under full retirement age. That is roughly $900 higher than the 2025 limit of $22,320 posted on SSA.gov. If you are still working and collecting benefits early, this number matters enormously to your check. Here is how the earnings test works in plain English for anyone who needs a refresher. If you collect Social Security before your full retirement age and earn above the limit, SSA withholds $1 for every $2 over. So if you earn $25,400 in 2026, that is $2,000 over the new limit. SSA would withhold $1,000 from your benefits that year, which is about $83 a month gone. Many seniors do not realize this withholding is not actually a permanent loss. Once you reach full retirement age, SSA recalculates your benefit and gives credit back for withheld months. But the cash flow hit in the meantime can be brutal if you are on a tight budget. Planning around this threshold can save you real stress and real dollars each month. Let me give you a specific example that shows why the new limit matters. Say you are 63 years old, collecting $1,600 a month in Social Security, and working part-time. If your part-time job pays you $28,400 in 2026, you are $5,000 over the earnings test limit. SSA would withhold $2,500 from your annual benefits, reducing your monthly check by roughly $208 for the year. Now here is the twist that catches people off guard every single time. There is a separate, higher earnings limit for the year you actually reach full retirement age. For 2026, that limit is projected to be approximately $62,160, based on SSA indexing trends. Above that amount, SSA withholds only $1 for every $3 over, which is much more generous. If you are turning 66 and 10 months, or 67 in 2026, depending on your birth year, this applies to you. The withholding only counts earnings in the months before you hit full retirement age. Once you reach full retirement age, the earnings test disappears completely and you can earn unlimited income. Knowing your exact full retirement age month is critical to planning your work schedule around this. The second hidden piece of the earnings test puzzle involves self-employment income. If you do freelance work, consulting, or run a small business, SSA counts your net self-employment earnings. Many retirees pick up consulting gigs or sell crafts online without realizing this income triggers the earnings test. Even a seemingly modest side income of $2,000 a month could push you over the limit fast. I always told my clients to track their earnings monthly starting in January. Do not wait until December to realize you have blown past the threshold. A simple spreadsheet or even a notebook can save you from an unexpected benefit reduction. The SSA will not warn you in advance. They will simply adjust your checks after the fact. One more nuance about the 2026 earnings test that most advisors never mention to their clients. If you receive a large one-time payment, like a bonus or settlement, it can count toward your annual earnings. That single lump sum could push you over the limit even if your regular income is modest. Always report significant income changes to SSA by calling 1-800-772-1213 as soon as they happen. The bottom line on this first hidden change is straightforward but powerful for your financial planning. The higher 2026 earnings limit gives you a little more room to work without losing benefits. But even a small miscalculation can cost you $1,000 or more in withheld benefits over the year. Know your number, track your income, and you will stay ahead of this rule. Stay with me, because what I am about to show you will surprise you even more than the earnings test changes. The next hidden change involves how Social Security calculates your benefit amount itself in 2026. Most people assume their benefit is locked in stone once they start collecting their monthly check. That is simply not true, and the 2026 adjustments to the bend points prove it. Let me explain what bend points are, because this is one of the most important and least understood concepts. Your Social Security benefit is calculated using a formula applied to your average indexed monthly earnings. The formula has $2 thresholds called bend points that determine how much of your earnings translate into benefits. These bend points change every year based on the National Average Wage Index. For 2026, the first bend point is projected to rise to approximately $1,226 based on recent wage growth trends. The second bend point is estimated to increase to roughly $7,391, according to SSA indexing methodology. These numbers determine the percentage of your earnings that convert into your monthly benefit amount. A higher bend point can mean a slightly higher benefit for people first claiming in 2026. Here is why this matters in real dollars you can feel in your bank account. Below the first bend point, you receive 90 cents of benefit for every dollar of average indexed monthly earnings. Between the first and second bend points, you receive only 32 cents per dollar of those earnings. Above the second bend point, you receive just 15 cents per dollar of your average indexed monthly earnings. If you are claiming Social Security for the first time in 2026, the higher bend points work slightly in your favor. Your initial benefit calculation will capture a bit more of your earnings at the generous 90% rate. For someone with average indexed monthly earnings of $6,000, this could mean an additional $14 to $22 per month. That adds up to $168 to $264 more per year just from this one quiet adjustment. But here is the part that frustrates people who already started collecting benefits before 2026 arrives. The bend points used in your calculation are locked to the year you turned 62, not when you claimed. So if you turned 62 in 2022, your benefit was calculated using the 2022 bend points permanently. The 2026 bend point increase does not retroactively boost your existing benefit at all. This creates a real disparity between people who are just 1 or 2 years apart in age. Someone turning 62 in 2026 gets a slightly better deal than someone who turned 62 in 2024. The difference might only be $10 to $25 a month, but over a 20-year retirement, that is $2,400 to $6,000. These are the kinds of quiet inequities that never make the news but affect real people. Now let me share a specific scenario that brings this to life for married couples watching today. Imagine Tom turned 62 in 2024, and his wife Linda turned 62 in 2026, and both earned similar incomes. Linda's primary insurance amount could be $18 to $30 higher per month simply because of bend point timing. Over both their lifetimes, that small gap could mean thousands of dollars in total household benefits. If you have not yet turned 62, you actually have a strategic advantage that you should understand. Every year you delay past 62, your bend points are set using higher thresholds from that later year. Combined with delayed retirement credits, waiting can significantly boost your eventual monthly benefit amount. This is one area where patience truly pays off in hard dollars every single month. The third factor tied to bend points that almost nobody discusses is the impact on spousal benefits. A spousal benefit is calculated as up to 50% of the higher-earning spouse's primary insurance amount. If the higher earner's PIA is boosted by favorable bend points, the spousal benefit goes up too. This is a multiplier effect that doubles the value of understanding these quiet annual changes. Let me also mention that disability benefits and survivor benefits use these same bend point calculations. If you are receiving SSDI, or if you are a widow or widower receiving survivor benefits, the same math applies. The year the disabled or deceased worker turned 62 determines which bend points were used in the calculation. Knowing this can help you verify that your benefit was calculated correctly by the SSA. Now here is the part most seniors never hear about, and it could be worth real money to you. The 2026 changes to the taxable maximum earnings cap will affect higher-earning seniors and working retirees. For 2025, the maximum amount of earnings subject to Social Security tax was $176,100, according to SSA.gov. For 2026, that cap is projected to rise to approximately $181,200 based on average wage indexing. If you are still working and earning above that threshold, you will pay Social Security tax on an additional $5,100 of income. At the 6.2% employee rate, that means up to $316 more in Social Security taxes for 2026. If you are self-employed, you pay both halves, which means up to $632 more in total payroll taxes. That is real money coming out of your paycheck or your quarterly estimated tax payments. But there is a silver lining to paying taxes on more of your earnings that many people overlook completely. Those additional taxed earnings can actually increase your benefit if they replace a lower earning year in your record. Social Security uses your highest 35 years of earnings to calculate your average indexed monthly earnings. If 2026 becomes one of your top 35 years, your future benefit gets a small but permanent boost. Let me walk you through exactly how this recalculation works with a real-world dollar example. Say your 35th highest earning year currently shows $45,000 in indexed earnings from decades ago. If you earn $181,200 in 2026, that new year replaces the $45,000 year in your top 35. The difference of $136,200 in indexed earnings, spread across 35 years and 12 months, could increase your monthly benefit. The math works out to roughly $324 more in average indexed monthly earnings from that single-year swap. At the 15% bend point rate for higher earners, that translates to about $49 more per month in benefits. Over a 20-year retirement, that 1 year of higher earnings could generate an extra $11,760 in total benefits. That far exceeds the additional $316 you paid in Social Security tax for the year. This is exactly why I always told my higher-earning clients to keep working even a year or two longer. Each additional high-earning year can potentially replace a low-earning year in your top 35 calculation. The benefit boost is permanent, lasts your entire retirement, and even increases your survivor benefit for your spouse. It is one of the best returns on investment most seniors never think about at all. Now let me address another hidden 2026 change that affects a very specific group of seniors directly. If you receive Social Security and also have a pension from work not covered by Social Security, listen carefully. The windfall elimination provision and the government pension offset are two rules that reduce Social Security benefits. Recent legislative changes under the Social Security Fairness Act, signed in January 2025, eliminated both WEP and GPO. This is monumental news for roughly 3.2 million affected beneficiaries across the United States right now. If you are a retired teacher, firefighter, police officer, or federal employee with a non-covered pension, your benefits may increase. The SSA has been processing retroactive payments and benefit adjustments throughout 2025 and into 2026. Some affected retirees are seeing increases of $300 to $800 or more per month, according to published SSA estimates. However, there is a critical detail that many affected seniors have not yet acted upon regarding this change. The SSA stated that most adjustments would be made automatically without requiring you to file anything new. But if you were previously denied a spousal or survivor benefit entirely because of GPO, you may need to apply. You should contact SSA directly at 1-800-772-1213 to verify your record has been updated correctly. Let me give you a real-world example of how the WEP and GPO repeal changes someone's actual retirement. Margaret retired as a public school teacher in Ohio with a state pension of $2,800 per month. She also worked enough quarters in the private sector to qualify for a $900 Social Security benefit. Under the old WEP rules, her Social Security was reduced to about $480 per month automatically. With WEP now eliminated, Margaret's Social Security benefit is being restored to the full $900 per month. That is an increase of $420 per month, or $5,040 per year, for the rest of her life. If Margaret is 66 and lives to 86, that single change is worth over $800 in additional lifetime benefits. And she also now qualifies for a spousal benefit she was previously denied under GPO. Margaret's husband Robert receives $2,400 per month in Social Security from his private sector career earnings. Under GPO, Margaret's spousal benefit was completely wiped out by a 2/3 offset of her pension. Now, with GPO repealed, She can receive a spousal benefit of up to half of Robert's primary insurance amount. That could add another $300 or more per month to the household income they desperately need. If you think you might be affected by the WEP and GPO repeal, here is how to check right now. Log into your My Social Security account at SSA.gov and review your benefit statement carefully today. Look for any notation about WEP reduction or GPO offset on your current benefit calculation page. If you see one, and your benefit has not yet been adjusted, call SSA immediately to request a review. The SSA has acknowledged that processing all WEP and GPO adjustments is taking time due to the sheer volume. Some beneficiaries may not see their corrected payments until mid or late 2026, according to SSA communications. But retroactive payments will be made back to the effective date of the law in January 2025. That means you could receive a lump sum of $5,000 to $15,000 or more when your adjustment finally processes. Now I want to reveal the hidden gem of this entire video that almost no senior knows about yet. There is a little-known Social Security provision that allows you to request a benefit recomputation at any time. If you worked after you started collecting Social Security and your recent earnings were higher than any of your top 35 years, SSA should automatically recalculate. But the automatic process sometimes misses people, and you can specifically request a manual recomputation. Here is why this matters so much for seniors who kept working even part-time after claiming benefits. Every January, the SSA is supposed to review the prior year's earnings and adjust benefits automatically if warranted. In practice, these automatic recalculations sometimes do not happen until October or November of the following year. Some recalculations are delayed even further, and a small percentage are simply missed entirely in the system. If you worked in 2024 or 2025 and earned enough to potentially replace a low year in your top 35 record, act now. You can call SSA at 1-800-772-1213 and specifically ask for a benefit recomputation based on recent earnings. You can also visit your local Social Security office in person and make the same request face-to-face. Bring your W-2 forms or tax returns as proof of your recent earnings to speed up the process. The eligibility criteria for this recomputation are simpler than most people think they would be. You must have worked and paid Social Security taxes after you began receiving retirement benefits from SSA. Your recent earnings must be higher than at least one of the 35 years currently used in your IME calculation. There is no fee, no special form, and no downside to requesting this review of your earnings record. I have personally helped clients discover they were owed an extra $30 to $120 per month through this process. One gentleman I worked with had earned $52,000 per year for 3 years after he started collecting Social Security. Those 3 years replaced 3 years from the 1980s when he only earned $18,000 to $22,000 on his record. His monthly benefit increased by $87, and he received a retroactive payment of over $1,400 for delayed adjustments. The beauty of this hidden gem is that it costs you nothing but a phone call or an office visit. The worst that happens is SSA tells you your benefit is already calculated correctly at the maximum amount. But if they find an error or a missed recalculation, you could see a permanent monthly increase plus back pay. In my experience, roughly 1 in 5 working retirees I reviewed was owed some additional amount from missed recomputations. Now let us talk about exactly what you should do today to protect and maximize your 2026 benefits. First, log into your My Social Security account at SSA.gov and verify that all your earnings are recorded correctly. Look at every year of your work history and compare it to your old tax returns or W-2 forms. If any year shows 0 or an incorrect amount, report it immediately because errors reduce your benefit calculation. Second, if you are affected by the WEP or GPO repeal, call SSA at 1-800-772-1213 this week. Ask specifically whether your benefit has been adjusted to reflect the Social Security Fairness Act changes enacted January 2025. If it has not been adjusted yet, ask for a timeline and get the representative's name for your records. Document everything in writing and follow up every 60 days until the adjustment appears on your statement. Third, if you worked after claiming Social Security, request a benefit recomputation by calling SSA or visiting your local office. Bring your most recent W-2 forms or self-employment tax returns as proof of your post-retirement earnings history. Ask the representative to compare your recent earnings against your lowest years in the top 35 calculation. If a recomputation increases your benefit, ask about any retroactive payments you may be owed for prior months. Let me quickly recap the 3 hidden 2026 changes we covered today that could put more money in your pocket. First, the higher earnings test limit of approximately $23,400 gives working retirees more room to earn without losing benefits. Second, the rising bend points and taxable maximum create opportunities for higher initial benefits and benefit recomputations. Third, the WEP and GPO repeal is generating increases of $300 to $800 per month for millions of affected public sector retirees. If this video helped you understand your Social Security benefits better, please hit that subscribe button below. I put out new videos every week covering the changes that matter most to your retirement security and finances. Next week, I will be covering a major Medicare Part D change for 2026 that could save you hundreds of dollars on prescriptions. This channel is for educational purposes only and does not constitute financial or legal advice. Always verify directly with SSA.gov or Medicare.gov.